everyone, welcome to Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Spotify. The 2026 Winter Olympic Games are officially in the books. If you look at the news, the headline is simple. Norway won, and the US and Italy had record-breaking years. But as any good analyst knows, totals only tell half the story. Today we're looking at Olympic Arbitrage, the practice of finding hidden value by looking at the same data through different lenses. We're going to see who actually won the efficiency game. First, let's look at the gross metrics, the raw, unadjusted totals. Norway remains the gold standard with 41 medals. The US and Italy followed with 33 and 30, historic highs for both. While these numbers show national power and massive investment, they obscure the underlying yield, or the actual return a country gets on its talent and money. To find the real overperformers, we need to look past the surface level standings and normalize these results. Think of athletes as capital investment. We're measuring the conversion rate. Simply put, the percentage of stock, aka athletes, that turned into a profit, aka medals. The alpha strategy. In finance, alpha is an investment strategy that beats the market through skill. Look at Norway and the Netherlands. They're in a league of their own with over 50% efficiency. That means for every 2 athletes they sent, they brought back a medal. These countries ultimately generated massive returns from a small portfolio of athletes. And then we have the index strategy. Larger teams like the US, Germany, and Canada operate between 10 and 15% efficiency. They aren't necessarily failing, they're just operating like an index fund. Buy into everything to ensure broad representation, which consequently ends up diluting the per unit yield. And then we have the scaling outliers. Italy, Japan, and a few others prove that you can scale up your team size without a diminishing return on your efficiency, with each country having massive teams over 100 athletes, but still being able to achieve greater than 15% efficiency. Now let's talk demographics. Does a bigger population guarantee more medals? Not necessarily. When we look at the medals per million people, the gap is staggering. Norway produced over 7 medals per million people. To match that, the US would have needed to win over 2,500 medals. That's 7 times the medals available in the entire games. This just shows that Norway wasn't just winning. They were operating at a density no one else could touch. In the Winter Games, money is a wealth floor, a minimum level of capital required just to even enter the market. Unlike the Summer Games, winter sports require massive infrastructure. Almost every winner sits above the 30,000 GDP per capita, with the exception of China. However, once this threshold is crossed, the correlation weakens, proving that wealth provides the opportunity, but specialization is what captures the gold. Now in this chart, I've categorized the field of country into 4 distinct quadrants. The high efficiency overachievers. Italy and Japan are beating the market here. They aren't the wealthiest nations, but they produce elite results for their price point. The powerhouse elite. This is the blue chip zone, where high wealth meets high success. The developing/specialist countries. Small or emerging programs that focus limited capital on dominating specific disciplines. And then the high wealth underperformers. Then there's countries like Denmark. High wealth but low medals. In situations like this, it suggests that cultural priority and demographic focus have been directed elsewhere. Finally, the ultimate ROI, or return on investment. This calculation strips away the advantage of sheer size to see which nations get the most bang for their buck from their total economic output. The US and China actually sit at the bottom here. Because their economies are so massive, the marginal cost, the cost of producing just one more medal, is astronomically higher than for smaller nations. The ROI specialists at the top of the table are Norway and Slovenia. Slovenia hit nearly 5 medals per 100 billion of GDP. That's roughly 45 times more efficient than the US economy in terms of sporting returns. They are the ultimate mid-cap success story. The 2026 games proved that while the US and Italy won on volume, the adjusted leaderboard tells a different story. Norway is the undisputed champion, leading in totals, per capita density, and economic ROI. They've proven you can scale without paying an efficiency tax. Meanwhile, the Netherlands and Slovenia have mastered the high-yield model, proving that a narrow, specialized portfolio can outperform global superpowers. The takeaway? Size is a luxury and wealth is a gatekeeper, but specialization is the multiplier. In 2026, the biggest winners weren't just the ones with the most resources. They were the ones who optimized them. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.